Chapter 4 Fundamentals. Considering that you decided to pick up a book about the stock market and read it, I'm confident that you can retire and become a millionaire if you're not already one. Becoming a millionaire becomes incredibly simple with consistent dedication, doing the same thing over and over, year after year. When you keep buying paper assets over time, the money you earn from those assets makes it difficult to be poor. By the time your wealth starts compounding at rapid rates, you cannot help but keep making more money. The three main factors behind growing your long-term portfolio are cash invested, depends on your career, lifestyle spending, and investing habits. Percent return received, depends on overall economic market performance and how much time you invest in trading to beat market returns. And time. Everyone has 24 hours in a day. The amount of money most people invest in the market usually depends on their income. Now, I'm not here to tell you how to budget your life, which coffee shop to skip in the morning, or how much money you should give away each year. Additionally, I do not know how you can make yourself more money by working either for yourself or for someone else. The responsibility of budgeting and increasing your income rests on your shoulders. You can make as much through investments as you want, and it is up to you to put away the amount of money you want to meet your retirement goals. The maximum amount of money you can physically invest in America, or a mix between the two. To see if you're on track to meet your goals, look up an online compound interest calculator or use the following formula, which assumes annual additions at the beginning of each year rather than monthly contributions with your current investment amounts. Initial investment times 1.07 to the power of years until retirement plus yearly contribution total times 1.07 to the power of years minus retirement plus 1 minus 1.07 divided by 0.07 equals retirement balance. Replace all sevens, representing a 7% market return, in the above equation with nines to get a conservative average estimate of your retirement balance in actual future dollar amounts after inflation. Many rising students go to college to increase their specialized knowledge and subsequent earning abilities. Because it can be tough to work, invest, study, and excel in college all at the same time, many college students do not start investing until they finish their degree programs. These degrees should allow graduates to earn more money in the job market, which hopefully allows graduates to contribute more to their retirement funds. Use your compound interest calculator to figure out how much you should invest if you expect to receive only the average market return. We will talk more about college in Chapter 7. The percent return you receive from your long-term portfolio can be difficult to increase if you only invest in indices, funds, and more diversified groups of stocks that we will discuss later. To significantly increase your percent returns without trading 9 to noon, master the trading principles and fundamentals we develop through Part 2 and apply them to medium-term swing trade positions or long-term technical analysis trades. The more you search for trading opportunities, the more opportunities you will find to beat the average market return. You can capitalize on opportunities you find on individual stocks by making your own proactive trades. The amount of time you have to grow your money is one of the hardest things to change, but it is one of the most important factors for long-term portfolio growth with little active management. Investing early on is one of the best things you can do. If you slack off and start your $5,004 per year retirement fund at 26 to retire at 66 with an initial investment of $5,004, our $2 million current dollar retirement fund turns into $1,143,834.47. We only removed 8 years from our investing, about 16.66% of our initial 48 investing years, but our end retirement balance decreased by about 43.38%. The money you have at the beginning of your investing has the greatest impact on your savings at the end. To show the truth behind this statement, let's look at 3 examples. Billy graduates high school at 18 and starts working immediately. He is lucky enough to have $5,004 saved from summer jobs. He starts a retirement account and funds it with $417 a month every month while he works very hard to bring in enough to provide for himself. He gets better at his job as the time goes by and uses this extra money to support other ventures. By the time he gets to 66, Billy has never missed a single investment, and Billy's market positions have performed at the historical average return. Billy has an account with $4,045,488 inflated dollars, $2,020,254.44 in current purchasing power. Bob goes to college right after high school and gets a 4-year degree. Bob works very hard during summers, and when he finds time during the school year to work and make enough money to pay for all his college expenses. After graduating, Bob excels in his field and manages to put away $10,008 a year, or $834 a month, with no initial investment since he uses all his spare money to pay for college. He works from age 22 to 26 and using raises he receives to fund other ventures. With average returns, Bob retires with an inflated $5,252,786.21, or $2,849,771.10 in current purchasing power. Joe is very smart and loves criminal justice system. Joe goes to an undergraduate school for 4 years after high school and then completes 3 years of law school. To fund his schooling, Joe trades 9 to noon before his classes and during the summer. After his first 4 years of college, Joe takes a gap year to travel the world and expand his social horizons before attending law school. At age 26, Joe passes the bar exam, receives his license, starts working as a lawyer, and begins saving for his retirement. Joe invests $20,016 a year, or $1,668 a month, until retirement age, with no initial investment because he used all of his stock profits to pay for his last year of law school. Under the same market conditions as Billy and Bob, Joe retires with an inflated $7,371,729.97, or $4,275,609.15 in current purchasing power. Billy, Bob, and Joe all have very respectable retirements, but they all live very different lives because of the educational paths and careers they embrace. One very important thing to remember is the importance of graduating college without debt. In fact, I would say that most people should avoid all debt entirely unless investing in real estate or settling down in a home. Student loans, unpaid credit cards, missing car payments, etc. all compound just like stock appreciation. However, unlike stocks, these liabilities compound negatively, increasing your debt by creating more debt with the debt you may already have. Living below your means for a short period of time will help you learn to avoid debts and maximize early investments in assets. Since eradicating any debts you unfortunately encounter as quickly as possible, always eradicate. Since the money you use to pay those back could go into your investment accounts, building your future up rather than destroying it. Speaking of living below your means, let's look at one example of spending discretionary income before investing it. Let's say you get a paycheck and eagerly go to the store to buy the newest $200 pair of shoes everyone's talking about. I think a better way to look at this purchase is to ask yourself a simple question. What would that $200 be if you put it in the stock market for 35 years? That $200 could turn into $2,135.32. in your retirement fund post-inflation. With that investment, you can now buy almost 11 pairs of $200 shoes in future money. That's the importance of investing early. Chapter 5. Following the rules to wealth. When you buy stocks, you go through brokerages to get them. These companies connect to the big name exchanges you hear about all over Wall Street. We will talk about brokers later, but you should remember one thing about these corporations. They all have to listen to the SEC. The SEC is the U.S. Securities and Exchange Commission, an independent federal agency created by the Securities Exchange Act of 1934. The SEC regulates the whole stock market, and they're important because they set all the rules for trading. You need to remember a few of the SEC's rules when you're investing, or else you risk a frozen brokerage account or cash liquidity issues. Brokers usually inform you about the most important SEC rules right before you break them, so you do not have to worry too much about actually researching them. With that said, there are two SEC identified circumstances that many people will have trouble with. The first issue you will run into very quickly if you start active trading in a cash account are cash liquidity violations, good faith violations, and free ride violations. These violations occur in a cash account because the SEC allows 1 to 3 days for a stock trade to clear, payments to settle, and shares to be transferred after a market trade. 3 days used to be standard, down from a historic 5-day settlement. In these settlement days, you'll run into serious problems if you try to sell shares you recently purchased before payments are cleared by the SEC, make a trade with money from a recent uncleared sell or short trade, see Chapter 14, or cover the cost of a stock by selling it quickly after purchasing it to pay for the purchasing trade. Thankfully, the SEC recently enacted the T+2 settlement on most securities in September 2017, expediting your trading in cash accounts. Nonetheless, you should avoid these three activities anyway, but some traders incur violations incidentally when trading quickly, even though they will have plenty of cash to fill their orders once their T+3 or T+2 balances settle. These violations usually result in long account restrictions and tons of investigative work that you want to avoid at all costs. To avoid this problem, ask your broker to open up a margin account if you start actively trading short-term or medium-term picks. When you trade on margin, you trade with the broker's money, essentially creating trading debt, which you should avoid at all costs. However, if you can use margin, your broker gives you to pay for your trades that you can afford once your trades clear. Using margin becomes pretty safe and allows you to avoid the tedious and inefficient clearing methods that govern cash accounts. We will talk more about brokers in Chapter 37. Trading on margin is almost like buying things with a credit card. You'll be fine as long as you only spend the money you have. If you spend a broker's money on a trade and lose money on the trade, you will owe the broker any money you lost, just like a normal cash trade. However, if you lost more than you can pay in your account, you'll also have to deposit more money to pay your debts, or else they will grow with interest. Significant margin losses happen more easily when you trade with leverage. If a broker grants you leverage with your margin account, you'll be permitted to trade with a certain multiple of your actual account value off margin lent money. This increases your trading upside, but it also allows you to demolish your account with large losses. Trading on margin and leverage with money you do not have is risky debt business that should be avoided at all costs. However, trading on non-leveraged margin is also almost required for active trading and lets you get the best fills and quickest orders possible. Just trade like you were trading with a cash account, and margin trading will be your best friend. The last SEC rule you ought to remember is the PDT rule. You'll be marked as a pattern day trader if you make 4 more round-trip buy and sell trades in the same 5 business days, 1 trading week. With an account worth less than $25,000 in equity, positions you hold for over 1 day do not count as round-trip trades and are not counted towards your 5-day limit. You will face PDT restrictions anytime your account net liquidation value falls under $25,000, and your account can get frozen after multiple violations of the rule. To avoid these punishments, remember to count your day trades when you are first growing your account. Long-term investors need not worry about this rule.